The mechanics of futures and margins. Most traders think they lose because they made a mistake. But in leveraged markets, the real danger isn't being wrong. It's being unprepared for the rules themselves to change. Overnight, your position can go from profitable to wiped out, not because of fear, but because of mechanical rules built into the system. Understanding futures markets. Futures contracts are agreements to buy or sell a commodity at a set price on a future date. They allow traders to speculate or hedge, but they require margin, a small percentage of the total contract value. Margin isn't a down payment. In the casual sense, it's collateral to ensure your obligations are met. Example, a 100,000 silver contract might require only 5,000 in margin. With leverage, a small price movement can multiply gains or losses by 20x. Initial margin vs maintenance margin. Initial margin, what you deposit to enter the trade. Maintenance margin, minimum balance to keep the trade open. If your account drops below maintenance, a margin call triggers. You must either deposit more funds or be liquidated. Real world example, a trader holds a long silver contract. Overnight, margin requirements rise by 50%. Suddenly, the account falls below maintenance, triggering an automatic liquidation. How margin rules change overnight. Exchanges can increase margin requirements due to volatility or perceived systemic risk. These changes aren't based on your position size, sentiment, or predictions. They are mechanical, automatic, and unavoidable. Historical note on some recent silver trading days, margin hikes triggered cascades that forced hundreds of accounts to close simultaneously. Leverage as a double-edged sword. Leverage can amplify gains, but it also amplifies vulnerability. Even small price moves, when magnified by leverage, can turn profitable positions into total losses in hours. Analogy: leverage is like a pressure cooker. Under the right conditions, it produces amazing results. Under stress, it explodes. Real life consequences. Forced liquidations often happen quietly overnight, leaving inexperienced traders shocked by the morning price. Accounts can be wiped out even if the market moves in the right direction, simply because the rules changed faster than they could react. This is not speculation or fear. It is mechanical inevitability. Understanding margins and leverage is the foundation for surviving chaotic markets. Without this knowledge, traders are exposed to invisible forces that can wipe out positions faster than any headline. Next, we'll explore how leverage turns small rule changes into massive price moves, and why knowing the mechanics isn't optional, it's survival knowledge. Leverage is the secret engine of modern markets, a tool that can magnify gains, but also destroy fortunes faster than most traders can blink. In simple terms, leverage allows you to control a position far larger than the cash you have on hand. For some, it is the difference between a modest trade and a life-changing gain. For others, it is a trap, a hidden razor lying in wait beneath the surface of seemingly calm markets. Imagine holding a silver contract worth $100,000 with only $5,000 of your own money. Every small movement in price is no longer just a number, it becomes a tidal wave. A 10-cent drop doesn't feel like a drop, it feels like an avalanche. And this avalanche doesn't wait for sentiment, for news, or for reason. It moves mechanically, ruthlessly, obeying only the rules embedded in the exchange and the broker's systems. The danger is not that the market is wrong. The danger is that the system's leverage multiplies the consequences of every rule change, every overnight adjustment, every sudden spike in margin requirements. Overnight, a position that seemed safe can vanish. Overnight, an account that looks secure can be reduced to nothing, not because of panic, not because of greed, but because leverage is unforgiving. Traders often imagine risk as something they can control with analysis, with charts, with careful planning, but leverage laughs at these illusions. It does not care about your strategy. It does not care about your predictions. It cares only about math. One misstep, one price movement, one mechanical trigger, and it transforms opportunity into catastrophe. This is why professional traders treat leverage like a living, breathing instrument, one that must be respected, observed, and contained. They calculate not just the upside, but the invisible downside, the path the system can take when stress hits. When leverage is applied across an entire market, its effects multiply exponentially. A single forced liquidation can trigger others, spreading like wildfire through accounts connected by margin calls and positions. Small rules, small changes, magnified by leverage, become events that no single human could anticipate in real time. And yet, this is how markets move when the hidden engine of leverage is running at full power. Understanding leverage is not a technical exercise, it is a matter of survival. It is understanding that profits are not guaranteed, and that the system does not forgive error, hesitation, or ignorance. Every trader, every account, every contract is subject to these invisible forces, and every market crash, every sudden spike, every unexpected liquidation is a reminder of their power. To see leverage in action is to witness a quiet, mechanical storm. It is not dramatic in the way a headline screams, nor in the way investors scream at their screens. It is methodical, relentless, precise, and it cannot be bargained with. By the time a trader realizes the danger, the wave has already passed. The lesson is clear: leverage does not reward recklessness. It does not favor the unprepared. It amplifies both brilliance and folly in equal measure. And in the world of futures, commodities, and highly leveraged instruments, Understanding this invisible force is not optional. It is the difference between surviving the storm and becoming another footnote in the history of market collapses. Leverage is not just a tool. It is the invisible current beneath the surface of every trade, shaping outcomes long before traders even see the first ripple. It turns what seems like a simple market movement into a chain reaction, a carefully orchestrated collapse that feels chaotic only to those caught in it. Consider the silver market, where contracts are tightly interconnected. A single overnight margin hike, seemingly arbitrary, can instantly make positions untenable. Accounts that appeared solid moments ago are suddenly underwater. The system does not negotiate, it does not pause, it executes automatically. Forced liquidations begin quietly, almost imperceptibly, in the dead of night. By morning, the cascading effects are visible across charts, in wiped-out balances and sudden price gaps. And it's not panic selling, as many news headlines claim. It is the system following its own rules, a machine executing with perfect mechanical precision. This is the terrifying power of leverage. Every trader who has faced this knows the feeling. A position that should have survived a normal market swing fails, not because of judgment or miscalculation, but because rules changed faster than reaction time allows. Initial margins rise, maintenance requirements climb, and positions that were once within safety thresholds are now exposed. The market does not care about sentiment, optimism, or strategy. It cares about the math embedded in the contracts, the formulas that govern collateral and exposure. And as leverage magnifies these forces, small shifts in price can have outsized consequences. A 10-cent move in silver might be inconsequential to a non-leveraged trader, but to an account controlling hundreds of thousands in contracts with minimal capital, it becomes catastrophic. This is why professionals spend hours studying not just price, but structure. They watch margin notices, liquidity conditions, and the behavior of leveraged participants. They understand that markets have invisible fault lines, and that a shift in leverage or margin rules can trigger a mechanical earthquake. Consider a scenario where a single hedge fund is forced to liquidate a large position. The selling pressure depresses the price, triggering maintenance margin calls for other traders. These, in turn, are automatically liquidated, creating a snowball effect. Within hours, hundreds of accounts can be affected, billions in notional value moving, cascading through exchanges with ruthless efficiency. It is easy to blame volatility or fear, but these are just byproducts, secondary effects. The real cause is leverage itself, the amplification of risk and reward, the magnifying lens through which every movement is projected. The market becomes a system of dominoes, each one carefully aligned, each one capable of triggering the next. And like dominoes, once the first falls, the sequence cannot be stopped. Traders watching charts often describe this as surreal, a mechanical inevitability unfolding in real time. One moment, the market seems calm, the next, positions are wiped out in a way that feels almost cinematic, the kind of event that makes headlines and dominates discussion for days. Yet, while most participants experience loss, some benefit. Market makers, funds positioned to absorb liquidations, and those who anticipate structural pressure often profit during these cascades. Leverage, while deadly for many, creates opportunity for those who understand its rhythm, its triggers, its hidden mechanics. The lesson is not conspiracy or luck, it is recognition of structure. To survive, one must respect the invisible currents of leverage, predict where pressure will build, and understand that in a leveraged system, the market is always in motion, even when the human eye sees stillness. And it is precisely this unseen motion that separates amateur traders from professionals. Amateurs react to price, professionals anticipate structural stress. They know that leverage can turn any small event into a major move. They know that overnight rules changes, margin hikes, and low liquidity periods are far more dangerous than headlines, rumors, or fear. When the market is quiet, leverage is quietly accumulating tension. When it moves violently. Understanding this is not optional, it is survival knowledge, the difference between being swept away and standing firm. In this world, every rule, every margin change, every leverage contract carries a story of potential collapse. To read it correctly is to read the pulse of the market itself. To ignore it is to risk everything. The system does not forget mistakes. It does not forgive miscalculations, and it certainly does not pause for comprehension. It moves on its own timetable, relentless, impartial, and absolute. And in this relentless flow, traders who understand leverage are not merely observers. They are navigators, steering through currents most cannot see, surviving where others are consumed, and occasionally profiting where others fall. In the silver markets, one of the most striking examples of leverage in action occurred during sudden overnight margin increases, when rules change without warning. Imagine a trader who holds 10 contracts of silver, each controlling a notional value far beyond the cash in their account. They go to bed with a sense of security, believing their position is within normal risk parameters. Overnight, the exchange raises margin requirements to guard against extreme volatility. The trader's account is now underfunded. By the time the market opens, positions that seemed safe have been automatically liquidated, leaving losses that dwarf anything that could have been anticipated based on price movement alone. This is the cold reality of leveraged markets. The system is impartial, but it is not forgiving. Leverage transforms small price changes into seismic events. A $1 move in silver, negligible to a non-leveraged investor, can wipe out entire accounts when leverage multiplies exposure 20-fold, 30-fold, or more. The magnitude is amplified not by panic or rumor, but by mathematics embedded in contracts and exchange rules. Traders caught unaware often describe the experience as surreal. Positions vanish not gradually, but in waves cascading across the market like a force of nature. The market doesn't scream, it doesn't wave warning flags, it simply executes the rules mechanically, efficiently, and ruthlessly. Consider the concept of liquidation cascades. One account hits its maintenance margin, triggering a forced sell. The price drops slightly. Another account, dependent on similar leverage, now also falls below the threshold. That account is liquidated automatically, creating further downward pressure. The process repeats, spreading through the market. By morning, the system has redistributed billions of dollars, wiping out small and medium traders while leaving larger, structurally aware participants poised to profit. This is not luck. It is the predictable result of leverage interacting with mechanical rules. Low liquidity periods exacerbate this process. Overnight trading, off hours, or holidays often have fewer participants, meaning the same volume of forced selling moves the price much more violently than during regular trading hours. Gaps form, creating apparent anomalies in charts. The casual observer sees panic, fear, or market irrationality. The professional sees mechanical inevitability, the silent logic of leverage revealing itself in price action. It is in these moments that the difference between an amateur trader and a professional becomes starkly apparent. One is reacting, the other is observing the system unfold. Leverage also explains why some traders benefit during these extreme events. While small accounts are destroyed, well-capitalized funds or market makers anticipate structural stress and position themselves accordingly. They are not speculating in the casual sense, they are engineering strategy around the predictable outcomes of leveraged rules. In the aftermath, they emerge as winners in a market that appears chaotic to outsiders. For most traders, the lesson is uncomfortable profits are not guaranteed, and market fairness is not measured in opportunity alone, but in knowledge of the hidden mechanics. Every overnight margin hike, every leveraged contract, every low liquidity session carries within it the potential for cascading effects. Professionals watch these factors like a pulse, understanding that mechanical stress can ripple through the system faster than sentiment or news ever could. The market moves not just in response to information, but to the invisible architecture of leverage, rules, and collateral. Recognizing this architecture is essential for survival. Ignoring it is equivalent to navigating a storm at sea without understanding the tides and currents, hoping that skill alone will suffice against forces beyond control. Over time, repeated events like these create patterns. A spike in leverage or margin requirements, followed by forced liquidations, creates turning points in the market. Not necessarily endings, but shifts in direction and structure. Price often recovers, volatility subsides, and the market appears calm once more. Yet those who experience the cascade firsthand carry the memory of its destructive power. Leverage has revealed itself, imparting a lesson that cannot be unlearned. Markets are indifferent to human perception, and rules can change faster than reaction time allows. Understanding leverage also requires understanding psychology. Human traders are wired to react to fear, to headlines, to sudden changes in price. But in a leveraged system, the emotional reaction often comes too late. By the time panic sets in, the system has already executed, and losses are realized mechanically. Professionals suppress instinctive reactions, focusing instead on system signals, margin notices, liquidity conditions, and structural vulnerabilities. They recognize the difference between price movement caused by sentiment and price movement caused by mechanical stress, and they act accordingly. In essence, leverage is the hidden engine of volatility. It creates the conditions for both extraordinary profit and catastrophic loss. It interacts with rules, contracts, and margins to produce movements that seem unpredictable until studied closely. And in markets like silver, where contracts are heavily leveraged and liquidity fluctuates, it becomes the defining factor of market behavior. To ignore it is to ignore the laws of motion within the market itself. To respect it is to navigate the storm with a chance of survival. One of the most infamous examples of leverage's destructive potential occurred in the silver markets of 1980. At the time, a surge in speculative buying pushed prices higher than many traders could imagine. Leverage was everywhere. Accounts were stretched, margins were thin, and optimism was high. But as the price neared its peak, the system began to strain under the weight of mechanical rules. Brokers increased margin requirements, forcing traders to either deposit additional funds or have their positions liquidated automatically. Overnight, many accounts that had seemed profitable during the day were wiped out in hours. This was not panic selling. It was the inevitable consequence of leverage interacting with rigid system rules. Positions were closed mechanically, cascading across the market and leaving a trail of losses that dwarfed the actual price correction. The mechanics of a forced liquidation cascade are deceptively simple, yet devastating in execution. Imagine a single account holding 10 contracts of silver, each leveraged 20 times. A small price movement, triggered by any factor, news, rumors, or simply random volatility, pushes the account below its maintenance margin. The broker steps in, automatically selling the position to cover the deficit. That sale depresses the price further, impacting other leveraged accounts. Each subsequent account falls below its threshold, triggering more automatic liquidations. The process spreads like wildfire, often across hundreds of accounts, magnifying the original price move far beyond its initial cause. The resulting chaos appears unpredictable to casual observers, yet it is perfectly predictable to those who understand leverage and mechanical rules. In recent years, the silver market has continued to demonstrate the same dynamics. Overnight margin hikes on COMEX contracts have forced widespread liquidations, often during periods of low liquidity when price gaps are most likely. Traders awake to discover their positions wiped out, not because the market turned against them in a conventional sense, but because the rules changed while they slept. Market makers and funds prepared for these structural events are frequently on the other side, absorbing forced selling and profiting from the predictable rhythm of leveraged markets. This is not speculation, it is understanding the invisible currents that govern price movement. Leverage also explains why the largest losses often appear disconnected from headline news. When mechanical stress is at work, the market moves independently of sentiment. Fear, hype, and rumor become secondary effects, not primary causes. Traders who react to headlines without understanding leverage are often the ones most at risk. By contrast, professionals watch margin levels, liquidity pools, and contract concentrations, anticipating stress before it manifests in price. They recognize that in a leveraged system, structural mechanics can dominate human behavior, creating extreme outcomes in a compressed time frame. The process is relentless because leverage is inherently self-reinforcing. As positions are liquidated, collateral is freed, sometimes allowing larger participants to re-enter at lower prices. The initial stress spreads through the system, creating volatility that persists even after the cascade ends. Markets may recover partially, but the lessons remain. Traders learn that profits can vanish not because of judgment errors, but because they underestimated the mechanical power of leverage. Every margin call, every overnight rule adjustment, every low liquidity session becomes a potential flashpoint. Understanding leverage also requires an appreciation of its psychological effects. Traders often describe the experience of forced liquidation as surreal. They enter the market confident, analyzing charts, reading news, and assessing fundamentals. Then, almost imperceptibly, the system enforces its rules. Positions close automatically, losses are realized mechanically, and human reactions lag behind the machine. Fear and panic arrive only after the fact, but by then, the damage is done. The market does not pause to allow emotion to catch up. It moves according to the logic embedded in its structure, indifferent to human comprehension. This combination of mechanical inevitability and amplified risk is what makes leverage both the most powerful and most dangerous tool in the markets. It is also why some participants benefit while others are destroyed. Market makers, funds anticipating forced liquidations, and traders monitoring structural signals position themselves to profit from these events. They are not relying on luck. They are relying on knowledge of how leverage interacts with margins, liquidity, and mechanical rules. In other words, they profit from understanding the system in ways that most traders do not. The historical patterns are consistent. From the silver panic of 1980 to modern COMEX events, leverage remains the central force behind rapid price movements and account wipeouts. Each event shares common elements: high leverage, thin margins, sudden rule changes, low liquidity, and cascading liquidations. These are the hallmarks of a system where mechanical forces dominate human perception. Understanding these patterns allows traders not only to survive, but, in some cases, to anticipate and capitalize on market stress. Leverage's impact is magnified during low liquidity periods, such as overnight trading sessions or holidays. With fewer participants, each forced sale moves the market more dramatically. Price gaps appear, accounts are liquidated, and the resulting volatility can persist for days. For the unprepared, this is a nightmare scenario. Positions that seemed secure during active hours are suddenly untenable. For those who understand the mechanics, it is an opportunity to observe, analyze, and, if structured correctly, profit from predictable outcomes. Even experienced traders must approach leverage with caution. It is a double-edged sword. The same tool that can magnify gains can also erase capital with mechanical efficiency. To navigate these markets, one must understand not only the concept of leverage, but its operational reality. How margin calls are triggered, how positions interact across accounts, and how low liquidity can turn minor events into catastrophic cascades. By studying past events, analyzing margin structures, and monitoring liquidity conditions, traders can begin to anticipate where leverage might create extreme outcomes. They learn to recognize the signs before the damage occurs: sudden increases in margin requirements, unusually concentrated positions, and periods of thin market participation. These signals are the pulse of the market, revealing the hidden stress before it erupts into visible chaos. The lesson is clear. Leverage is not optional, and neither is understanding it. In futures markets, commodities, and any instrument that allows positions far beyond capital on hand, mechanical risk is real and omnipresent. The difference between those who survive and those who are destroyed is knowledge, preparation, and respect for the invisible forces that govern market behavior. As the cascade unfolds, the human element becomes starkly visible. Traders describe the morning after an overnight margin hike like waking in a different world. Accounts that were thriving hours before are now depleted, charts are riddled with gaps, and positions vanish as though erased by some invisible hand. Yet there is no hand, no conspiracy, no unseen villain. There is only the system executing rules with ruthless consistency. The shock is profound because human intuition cannot keep pace with mechanical inevitability. You cannot reason with leverage, you can only respect it, anticipate it, and structure your positions to survive its force. For some, the losses are devastating. Individual traders, small hedge funds, and inexperienced participants are caught in a web they cannot see, watching as the logic of leverage unfolds without mercy. For others, the event is an opportunity, a window to profit from stress that most cannot comprehend. Market makers and structurally aware participants know when and how margin rules shift, how liquidity fluctuations amplify mechanical risk, and how cascading liquidations create openings. It is not luck, it is knowledge applied to structure. Consider a scenario from recent COMEX activity. Overnight, margin requirements rose sharply on silver contracts. Accounts with significant leverage were automatically liquidated, selling tens of thousands of contracts in a matter of hours. The resulting price drop triggered more margin calls, cascading through multiple firms. By the time morning trading began, prices had dropped dramatically, wiping out unprepared accounts, while leaving larger, structurally aware traders with positions ready to capitalize on the rebound. To an outsider, the market appeared chaotic. To the professionals watching the structure, it was entirely predictable, a mechanical unfolding of forces they had studied and understood. The consequences of leverage extend beyond immediate losses. These events teach hard lessons about risk, discipline, and market awareness. They expose the fragility of accounts built on optimism and leverage without preparation. They reward those who respect the system's architecture and punish those who ignore it. Emotional reactions, panic, and fear are secondary phenomena. The primary driver is structural mechanical rules magnified by leverage. Understanding this is not optional, it is survival knowledge, the difference between being swept away and maintaining control when chaos hits. In markets dominated by leverage, volatility is not random. It follows patterns dictated by the interaction of rules, margin requirements, and liquidity. By observing past events, traders can see the signature of mechanical stress before it becomes visible on price charts. Sudden spikes in margin, concentrated positions, and thin liquidity are signals, the pulse of a system preparing to release pent-up pressure. Those who read these signals can adjust, hedge, or step aside. Those who do not are vulnerable to mechanical devastation. The lessons of leverage are reinforced repeatedly across history. From the silver panic of 1980 to modern overnight margin hikes, the pattern is consistent high leverage, sudden rule shifts, forced liquidations, and cascading losses. The human narrative, fear, panic, hope, is always secondary. The system is indifferent. Profits and losses are determined not by sentiment, but by structure. Understanding leverage is understanding the invisible forces that dictate who survives and who falls. For traders watching today, the key insight is this: mechanical risk precedes visible chaos. By the time losses are apparent, the cascade has already occurred. The opportunity or the danger lies in anticipating the invisible pressures before they manifest. Professionals know this. They monitor margin requirements, account concentrations, liquidity conditions, and contract structures. They prepare for events that seem unlikely to the casual observer, but are inevitable once leverage reaches critical thresholds. A forced liquidation is the market's silent executioner. It does not scream. It does not wait. It does not negotiate. It moves with mechanical precision, triggered the moment a margin requirement is breached. To witness one is to understand the raw power of leverage and the immutable logic of the system. Imagine a single trader holding a large leveraged position in silver, a position that seems solid by day's end. Overnight, the exchange raises the maintenance margin. The account now falls below the threshold, triggering an automatic sale. The trader is unaware, asleep in their home, yet the system has already acted. The liquidation begins, not because of fear, not because of a sudden rush to sell, but because rules demand it. One contract sells, then another, cascading through the account. The pressure is transferred instantly to the market. The first sale depresses the price slightly. For a casual observer, this may appear insignificant, a minor fluctuation. But for other leveraged accounts, it is enough to push balances below maintenance levels. Another margin call is triggered, and another automatic sale follows. The process repeats, spreading across dozens, hundreds, sometimes thousands of accounts. Each account's liquidation pushes prices further, each sale amplifying the mechanical force already in motion. This is the anatomy of a cascade, and it is terrifying in its efficiency. No trader can react fast enough to stop it. No analysis can reverse it once the chain begins. Liquidity, or the lack thereof, plays a critical role. During normal trading hours, the market has enough participants to absorb forced sales. The impact is muted, and prices adjust gradually. But during overnight sessions, thin liquidity magnifies every trade. A single forced sale moves the price more dramatically, triggering additional margin calls in a feedback loop. Price gaps form, charts look chaotic, and accounts are wiped out in a fraction of the time it would take during normal trading. To outsiders, it appears as if the market is collapsing irrationally, but professionals understand it as the predictable outcome of mechanical stress amplified by leverage. Not all accounts are equal in this environment. Smaller, undercapitalized traders are most vulnerable. Their margins are tight, their positions concentrated, and their ability to respond limited. Larger participants, hedge funds, and market makers often anticipate these moments. They know when and where forced liquidations are likely to occur, and they position themselves to absorb selling or even profit from the cascading pressure. In the same storm that destroys one participant, another emerges stronger, highlighting the asymmetry embedded in leveraged markets. Step by step, the mechanics are deceptively simple but devastating. A margin call is triggered when the account balance falls below the maintenance margin. The broker executes sales automatically, liquidating contracts to restore balance. Each sale depresses the price, potentially triggering additional calls in accounts with similar positions. The process continues until either the stress is absorbed or the system runs out of vulnerable accounts. The chain reaction is amplified by leverage, concentration, and low liquidity. By the time the dust settles, the market has redistributed risk, wiped out unprepared traders, and created opportunities for those structurally aware. Forced liquidations are not anomalies, they are systemic features. Every leverage market carries the potential for them. Every margin rule change has the ability to initiate them, and every low liquidity period is a catalyst. Traders who ignore these mechanics do so at their peril. Profits vanish not because of poor analysis or emotional trading alone, but because they underestimated the invisible architecture of the market. Understanding the step-by-step unfolding of a cascade is not optional, it is the blueprint for survival. Historical examples make the danger clear. During the 2008 financial crisis, leveraged positions in commodities and derivatives triggered massive overnight liquidations. Entire accounts were wiped out not by market sentiment, but by mechanical margin enforcement. Prices gapped violently, liquidity evaporated, and the system redistributed risk with ruthless precision. Traders who had prepared for structural stress, who monitored leverage and account concentrations, survived. Those who relied solely on analysis, prediction, or intuition did not. The lesson is timeless. In leveraged markets, mechanics matter more than emotion, structure more than sentiment. The spread of liquidations is almost like watching a forest fire. It starts with a single spark, an account breaching margin, but the dry tinder of leverage allows it to spread across the market. One account's forced sale fuels another, creating a chain reaction that moves faster than any human can react. Traders awake to find balances erased, positions gone, and prices disrupted, often thinking the market behaved irrationally, when in reality it acted exactly as the system's rules dictated. The beauty and terror of this process is its predictability for those who understand it. Margin calls, forced liquidations, and cascading losses follow a logical sequence. Each account is a domino, each rule a law of motion. For professional traders, anticipating these sequences is not speculation, it is analysis of the underlying structure. By studying concentration of positions, margin levels, liquidity conditions, and recent rule changes, they can predict where the cascade will strike and adjust accordingly. Even within the chaos, opportunity exists. Market makers and strategically positioned participants often profit during liquidation cascades. By understanding the anatomy of forced selling, they can absorb pressure at the right moments, deploy capital strategically, and position themselves for rebounds once the cascade has run its course. While the majority of traders are consumed by the mechanical storm, a few emerge unscathed or even stronger, demonstrating that knowledge of structure can turn risk into reward. The anatomy of forced liquidations also reveals why markets are rarely truly random. Every price gap, every cascade, every dramatic move has a cause rooted in leverage, margin requirements, and liquidity. Human emotion may color the narrative, but the underlying engine is mechanical. Recognizing this is crucial. Traders who focus solely on news, rumors, or sentiment are reacting to effects, not causes. Those who understand the mechanics are watching the system itself, anticipating outcomes before they manifest in price. By the end of a forced liquidation cascade, the market has done more than redistribute positions. It has enforced discipline, punished the unprepared, and rewarded those who respect structure. Accounts that survived now have a renewed perspective on leverage, risk, and the invisible forces governing price. Those that did not have learned, often too late, the harsh lesson that in leveraged markets, rules are stronger than intuition, and timing is everything. Chapter 3 closes with the stark reality that forced liquidations are inevitable in leveraged markets. They will occur again as long as leverage exists, margins fluctuate, and liquidity varies. Understanding them, anticipating them, and respecting the system's mechanics is not optional. It is the path to survival, the difference between devastation and opportunity, the essential skill every trader must master before stepping into markets where leverage reigns supreme. In the next chapter, we will examine price gaps, low liquidity sessions, and the spread of cascading liquidations in even greater detail, showing exactly how structure, rules, and mechanics combine to create market events that seem chaotic but are perfectly predictable for those who know where to look. Price gaps are the most visible fingerprints of a market under mechanical stress. They appear suddenly on charts, spaces where the price jumps from one level to another without trading in between. To casual observers, they seem like anomalies, irrational leaps caused by panic or rumor. In reality, price gaps are the direct result of structure, leverage, and liquidity interacting under stress. They are the clearest evidence that markets are not merely collections of human decisions, but systems governed by rules that can overwhelm emotion, sentiment, and intuition. Consider an overnight session in silver trading. Volume is thin, participants are few, and liquidity is limited. A sudden margin hike occurs, or a large leveraged position is forced to close. The first few contracts sell at one price, but there are not enough bids to absorb the volume at the current level. The market jumps to the next available price, creating a gap. This is not random. It is the predictable outcome of mechanical execution under low liquidity. Each gap tells a story of stress released, of rules enforced, and of leverage's invisible hand shaping price. Price gaps are particularly dangerous because they amplify the effects of forced liquidations. When a gap occurs, it can push other accounts below maintenance margins instantly. Positions that might have survived a gradual decline are now wiped out in one jump. Cascading liquidations follow, magnified by the very mechanics that created the gap. Overnight, what seems like a small disruption becomes a violent, systemic event. Traders awake to find balances erased, charts distorted, and volatility spiking, often attributing the chaos to headlines or fear, when the real cause is purely structural. Liquidity is the hidden moderator of market behavior. During active trading hours, participants can absorb forced sales, smoothing price movements and preventing extreme gaps. But during low liquidity sessions, even small volumes of selling can produce large price jumps. The system is less forgiving. The rules act faster than human response. Market participants who understand this anticipate stress points, watching when liquidity thins and large leveraged positions exist. They can position themselves to take advantage of gaps, or more importantly, protect themselves from cascading losses. Structural dynamics also dictate how gaps propagate through the market. Concentration of positions matters. When many accounts hold similar leveraged trades, a single forced sale can ripple through hundreds of positions. Each gap triggers additional margin calls, each call triggers more selling, and the cascade spreads. The market moves in jumps, leaving visual gaps on charts that are more than cosmetic. They are evidence of the mechanical process at work, a language that reveals where leverage, liquidity, and rules intersect to create extreme outcomes. Historical examples illustrate this vividly. During the 2008 financial crisis, gold and silver markets experienced multiple overnight gaps. Leverage positions were forced to liquidate during thin, volume sessions, producing dramatic jumps in price from one level to another. Analysts observing the charts could see the structure of stress being released, first a small move, then a larger gap, followed by cascading liquidations, and finally a partial recovery as liquidity returned. Each gap was a visible trace of mechanical risk being enforced by the system. Price gaps also explain why market reactions can feel disproportionate. A 5-cent move in a high liquidity session may be negligible, but the same movement overnight can trigger cascading liquidations across multiple accounts, producing a gap of tens or hundreds of cents. Traders who fail to understand this structural effect may misinterpret the cause, attributing it to sentiment or news rather than the predictable result of mechanics and leverage. The combination of leverage, low liquidity, and structural concentration creates a perfect storm for gaps. When positions are highly leveraged, a small price movement can be amplified. When liquidity is thin, the market cannot absorb the pressure gradually. When accounts are concentrated in similar trades, a single liquidation spreads like wildfire. Price gaps are the visible signature of this interaction, revealing the hidden logic of a system that moves independently of human perception. Professional traders read gaps like a pulse. The size, timing, and context of a gap provide information about underlying risk, liquidity conditions, and potential for further cascades. Gaps are not just price anomalies, they are signals of structural stress, opportunities for those who understand the mechanics and dangers, for those who do not. Ignoring them is costly. Respecting them allows for anticipation, strategic positioning, and survival in markets that often appear chaotic but are, in fact, following mechanical logic. As leverage interacts with gaps, the risk of cascading liquidations increases exponentially. Each jump in price can push additional accounts below maintenance margin, triggering more sales, more gaps, and more volatility. The market becomes a machining motion, executing rules faster than any human can react. By the time the average trader sees the full effect, it is already history. Professional participants, however, see the process unfolding in real time, recognizing patterns, identifying pressure points, and positioning themselves accordingly. Liquidation cascades are the hidden storms of leveraged markets. They do not begin with panic, they begin with a rule. One account breaches its maintenance margin, triggering an automatic sale. This is the spark, the first domino. The system executes with precision, oblivious to human perception or emotion. The initial liquidation depresses the market price, a small tremor in the eyes of an outsider, but a seismic jolt to other leveraged positions. Accounts with similar exposure now find themselves below required margins. The next domino falls. Another account is liquidated. More contracts are sold, more pressure is applied. The process repeats, each sale feeding the next, each drop magnified by leverage. The spread of a cascade is almost like watching a fire move through dry timber. The spark alone does not destroy the forest, but the combination of fuel, wind, and proximity turns a single flame into an unstoppable inferno. In markets, leverage is the fuel, low liquidity is the wind, and account concentration is the proximity. Each forced liquidation is a flame. The cascade moves through the system with mechanical inevitability. Traders caught in the path have no time to react. Positions are closed automatically, losses realized mechanically, and by the time a human notices, the damage is complete. Liquidity, again, plays a critical role. In active sessions, markets can absorb pressure. A large liquidation may depress the price slightly, but bids are available to prevent cascading failure. In thinly traded sessions, however, each forced sale has an outsized effect. Prices jump, gaps appear, and additional accounts are triggered in rapid succession. What begins as a single breach becomes a multi-account collapse, leaving a trail of liquidated positions in its wake. The system does not discriminate. It follows the rules, and the human cost is a byproduct, not the intent. Not all participants are equally vulnerable. Smaller traders, accounts operating near the margin threshold, are the most exposed. They feel the cascade first and hardest. Larger, structurally aware participants anticipate these movements. They monitor margin levels, account concentrations, and liquidity conditions. When a cascade begins, they often absorb selling at strategic points, mitigating losses or even profiting from the predictable path of the liquidations. In other words, the system is asymmetric, it punishes the unprepared and rewards those who understand its rules. The mechanics are precise. One account falls below maintenance margin, triggering the sale of a set number of contracts. The price declines. Another account with similar exposure breaches its threshold. More contracts are sold. This continues until either all vulnerable accounts are liquidated or the market absorbs the pressure. Every step is automatic, every movement predictable in hindsight, and every loss the direct result of leverage interacting with structural rules. The process is repeated across exchanges, across instruments, across markets, creating widespread effects that often appear chaotic but are mechanically inevitable. Historical events demonstrate the power of cascades. During the 2008 financial crisis, leveraged positions in commodities, currencies, and derivatives triggered massive forced liquidations across multiple exchanges. Accounts were wiped out overnight, prices gapped violently, and volatility spiked. To an outsider, the market seemed to collapse irrationally. To a professional observing structural mechanics, the process was entirely predictable. Highly leveraged positions, low liquidity, and margin adjustments combined to produce the cascade. The lesson was clear in leveraged markets. The rules move faster than human reaction, and mechanical processes dominate perception. Cascades also explain why some traders profit while others are destroyed. Market makers and strategically positioned participants can anticipate where the system is stressed. By monitoring leverage, account concentration, and liquidity, they identify points where forced sales are likely to occur. When a cascade begins, they deploy capital, absorb selling pressure, and position themselves to profit from the rebound. While the majority of traders are caught in the mechanical storm, these participants exploit the predictable path of liquidations. This is not luck, it is mastery of the system's hidden structure. Every cascade leaves lessons etched into the market. The first is that leverage magnifies risk in ways that human intuition cannot always grasp. The second is that liquidity matters more than analysis or prediction during extreme stress. The third is that mechanical rules create outcomes that can appear chaotic but are actually perfectly logical. Accounts are destroyed not because of emotion, but because the system enforces rules designed to ensure collateral integrity. Understanding these lessons is the difference between survival and devastation. Cascades unfold in phases. The initial trigger, often an overnight margin adjustment or a large leverage trade, starts the process. The propagation phase spreads pressure through the market as accounts breach maintenance margins. The amplification phase occurs in low liquidity conditions, where each sale depresses the market further, triggering additional liquidations. Finally, the resolution phase sees the market absorb the pressure, stabilize, and create opportunities for those who remain structurally aware. Each phase is a step in the anatomy of a cascade, and professionals learn to read these phases in real time, anticipating pressure before it becomes visible in price. The human element, while secondary, is never irrelevant. Traders who panic, who fail to respect the mechanics, or who are unaware of structural risks are destroyed first. Their losses feed the system, creating opportunities for those who study, anticipate, and respect the rules. Emotional trading becomes the fuel for mechanical outcomes. Discipline, preparation, and structural awareness are the tools that allow some to navigate the storm.